Good morning, everybody. Welcome to our April 24th, 2020 Coronavirus COVID-19 Response Team morning webinar. This is Erik Daly from Miller Johnson. I am a member in our corporate and business practice group, and today we will be talking a little bit about the latest congressional expansion of the Paycheck protection program, as well as some additional funding for related SBA loan programs. And we will also just do a bit of a roundup of some recent SBA frequently asked questions and guidance that have come out over the last week or so. Before we do that, I always like to begin these webinars by reviewing some of the guiding principles that we at Miller Johnson are adhering to, and we know the community as a whole, particularly our community here in West Michigan, follow as they try to navigate this situation. And for us, those guiding principles are collaboration, ingenuity, candor, integrity, and intellect, and those are the qualities we bring to bear and try to follow every day as we're doing our work under these unusual circumstances. And that's the mindset we'll have during today's webinar. Before we get into the substance of the PPP and SBA loan issues, we also like to begin our morning webinars by just doing a quick roundup of sort of latest news developments, typically with an emphasis here in Michigan, where we are located. Governor Whitmer has evidently indicated some consideration of opening up businesses that pose, quote unquote, very little risk. I don't believe any specific industries or businesses were identified in that commentary, but it was a sign that there may be some upcoming loosening of the stay-at-home order and the central business restrictions on the commercial side for businesses. However, I just note at the same time that the UAW president has indicated that they need more evidence that workplace safety will be paramount before they're comfortable with their employees returning to work. And obviously here in Michigan, that's a significant commercial consideration, probably a significant political consideration, how the UAW views a potential return to work. So just something to keep an eye on there as things progress over the next couple of weeks. The background of this is also that although there had been some leveling off of new COVID-19 cases in Michigan in recent days, it looks like there was a jump in cases reported yesterday to the highest level in the last 9 days. I don't know if that's anomalous or a result of reporting issues or more reflective of real-time information, but it's a statistic that's out there and probably will inform some of the public commentary and public policy around these issues, at least here in Michigan. And then some other states have started to reopen businesses. Georgia is one that's gotten a lot of reporting. It looks like Oklahoma may start to reopen some businesses as soon as today. So as that continues to happen, obviously tracking how that works or doesn't work for different industries in different states will probably have a ripple effect throughout other jurisdictions as they try to navigate the same issues. So something to keep an eye on there. And then the last item I've got noted is what we're going to talk about today, which is that Congress approved another coronavirus relief package, the total amount of which, in terms of dollars, is listed at $484 billion. Of that, $100 billion is for hospitals and COVID-19 testing, 25 billion for testing, 75 billion for hospitals. So the remaining 384 billion is all related to Small Business Administration programs, most of that being the Paycheck Protection Program, but some other things as well. And that's what we're going to spend the first half of today's webinar talking about. So that is the news backdrop. Here you go. Today's topics again. We'll discuss the appropriation expansion, and then we'll go through some recent guidance, and we'll also just do some Q&A through the webinar app here, the Zoom app. Okay, we can go to the next slide, please. So just very quickly to provide context, I think probably most people on the phone or on the webinar know what the PPP is, but essentially it's a small business loan program that may result in whole, complete, or partial forgiveness of the loans that are made by banks participating in the Small Business Administration's PPP scheme. The main goal of the program from a policy perspective is for small businesses to be able to continue to pay payroll costs, so at least 75% of the loan and 75% of the forgiveness amount sought must be spent on payroll costs, quote unquote, and that's a defined term that includes things beyond just wages, health care benefits, retirement plan payments, things like that. So that's the main purpose of the legislation. And the loans, the forgiveness level of the loans will depend on whether it's used for those things appropriately that are forgivable expenses, and whether the borrowers retain, to what extent the borrower retain levels of full-time equivalent employees and wages from the pre-COVID-19 world, if you want to think about it like that. And there's a lot of detail that I'm glossing over there, but that's sort of the basic idea of the program. It's a very complex program, so we'll get around to in the FAQs and guidance. So I know probably a lot of the webinar participants today are neck deep in a lot of those details and nuances, but we won't be able to address all of the questions because we don't have all of the SBA guidance yet, but we'll do our best to navigate based on what we do know presently. And because these loans are administered by the SBA, naturally they're available to small businesses and small business concerns. The scope of eligible borrowers has been expanded beyond what the SBA would typically allow, to include organizations like not-for-profits, but also self-employed and gig economy workers. And theoretically, the loans are available until June 30th, 2020. But as we saw with the first round of $349 billion in appropriations, if the funds are exhausted, then the SBA will, and the banks who are processing the SBA loan applications will not accept additional loan applications for approval. So realistically, the program is available until funds are exhausted. And that happened in 13 days after the application process opened up last time. So we'll see what happens with this additional $310 billion that's been allocated. A lot of it may already be spoken for. Next slide, please. This is an executive summary of some of the key terms of the PPP. I won't go through all of it just because I think many people are probably familiar with it, but basically the amount of your loan is determined as 250% of your average monthly payroll costs, subject to a $10 million maximum. There's no personal guarantees or collateral required, no credit elsewhere testing, there's deferral of interest and any kind of payments for the first 6 months. And again, it's forgivable to the extent that it's used for certain expenses during the 8-week period after the loan is funded, subject to retention of full-time equivalent employees and certain compensation levels. And then, again, critically, at least 75% of the loan spend, as well as the forgiveness amount sought, must be toward payroll costs. The key thing about this loan, obviously, that makes it so attractive is the forgivability of certain of these expenses, which is, driven a lot of the demand. Another thing that has, I think, driven a lot of the demand and the speed with which the funds were deployed initially is the kind of first come, first served nature of the program that was set up, so that sort of a shoot first, aim second approach for a lot of borrowers, because they didn't want to miss a chance to participate in the program. And then the SBA issued some additional guidance that maybe changed things for people. So it's been a very, in some circumstances, very confusing rollout of the program, although, I think the SBA is doing their best under the circumstances of trying to get these funds out and into the accounts of small businesses relatively quickly. And next slide, please. Okay, so that's the backdrop. Again, very high level backdrop. There's a lot more detail of the PPP in general. Yesterday, the House of Representatives approved a previously passed Senate bill that expanded and provided additional appropriations for the PPP, increasing the overall funding for that specific program from $349 billion to $659 billion. So it was really just an amendment to the previously passed CARES Act. There were no other changes to the PPP terms and conditions, at least in the legislation. There have been changes based, I would describe them as changes based on SBA guidance and FAQs, but no actual changes in the legislation beyond just the additional funding. And of that $310 billion increase in the PPP funds, $60 billion was specifically set aside for smaller lenders. The idea being sort of underbanked businesses and borrowers might be more likely to originate a loan with one of these smaller lending institutions. So community financial institutions, smaller insured depository institutions, and credit unions with asset levels below certain thresholds will have $60 billion earmarked for them to originate loans that are guaranteed under the PPP program. Next slide, please. So the initial $349 billion appropriation, as I mentioned, was exhausted in 12 and a half days, including, I think, 4 of those days were weekend days. So under 10 business days after they started accepting applications at banks. So there's been some reporting that the additional $310 billion may already essentially be spoken for, if you will, by loan applications that are already in the pipeline, but which were halted when the initial appropriation maxed out. I don't have total visibility into that, but that apparently is what some banking associations have suggested. So, if you already put in an application and determined you were eligible for the PPP, and now you see that there are new funds and you weren't able to participate before because the funds were exhausted, you're going to want to obviously check on the status of your application with your bank and see kind of where it sits in the queue to determine, if there's any additional information you need to provide to make sure that that's in line with the other applications that, may receive some of that $310 billion in additional appropriations. And then, I wouldn't be shy about reaching out to whoever your contact is, just to make sure you fully understand that and be proactive and seeing if there's anything that you need to do or provide in terms of information or new certifications to bring bring the dates on applications, current, things like that. I don't know to what extent the banks will want to have updated, more current signatures, for example, on applications that they then submit to the SBA. So there may be some logistical things to work out with your bank, even if you had already submitted your application. And then if you have not yet submitted an application, you're a potential new borrower, one, consult first with your professionals to determine if you're eligible or not, and do that quickly because, as I mentioned, it sounds like this $310 billion will go very quickly, maybe faster than a new applicant will be able to collect the information they need, which would, depending on what type of borrower they are, would include payroll cost information, or if you're a self-employed individual, potentially some tax-related documents. And then if you're a new client of a bank where you're seeking a loan or a credit union, you also probably need to provide know your customer KYC information. So there's a lot of information to collect there. And even if you think, well, I'll be too late to participate in this $310 billion additional appropriation, it may be that there's yet another round of increased appropriations for PPP loans in the future. Can't guarantee that, obviously, but if there is, then at least you would have done some of the work to collect this information and then be ready if there is a third round of funding. Next slide, please. So in addition to the PPP appropriations, the legislation included an additional $50 billion for the Economic Injury Disaster Loan, or EIDL program, and $10 billion beyond that $50 billion, so a total of $60 billion related to the EIDL. Another $10 billion is related to just the Emergency Advance or Grant Program under the EIDLs. So that, for people who been following this, the EIDLs are different types of loans than the PPP loans. They're not forgivable, and there's a potential for up to a $10,000 advance associated with those loans, and the funds for those loans were also, and those advances were also exhausted under the under the CARES Act. So there's some additional appropriations here. And then there was also an appropriation for additional $2.1 billion for Small Business Administration salary and expenses. And hopefully this will be deployed quickly, because the SBA was criticized, fairly or not, for being understaffed and technologically unprepared for the first wave of PPP loan applications. And unfortunately, there were also some data breach reports associated with the EIDL loan application process early on, and it's my understanding that the SBA has notified some of the early EIDL borrowers about that data breach, which sounds like it was pretty significant in terms of the types of information that was potentially compromised. So if you were an early EIDL applicant, you might want to look for that and understand that there could have been some compromise of your business and personal information. Next slide, please. So this is just a very high-level overview distinguishing the EIDL loans from the PPP. I won't go through all the details, but as I mentioned before, EIDLs did receive additional appropriations, not nearly as much as the PPP, but these loans are not forgivable other than the $10,000 advance I mentioned, which is just a grant that doesn't need to be repaid. And the loans are capped at $2 million. Interest rates are higher than the PPP loans. The PPP loan interest rate is 1%. You can see the interest rates here are, depending on whether you're for-profit or not-for-profit, are either They can be up to 3.75% or 2.75%. The repayment time frame may be longer for this type of loan. It's 2 years for the PPP loan, whereas this EIDL would be up to 30 years. And some of the permitted loan uses are different for EIDL loans. There's not that 75% payroll cost requirement, so you could use these loans for, vendor payments, for example, which would not be permitted under the PPP loan program. And then there may still be collateral and guarantee requirements under the EIDL where there are not under the PPP. Next slide, please. There's a few other points about EIDLs. You apply directly through Treasury for these, unlike the PPP loans where you would go through a bank or a credit union or another eligible lender. There's a temporary expansion of eligible borrowers for EIDLs, including ESOPs, and this latest round of legislation further extended eligibility for EIDLs to clearly include agricultural enterprises with 500 or fewer employees. Similar to the PPP loans, there's no credit elsewhere testing, so you don't have to show that you couldn't obtain a loan from another source before applying. And then there's relaxed financial information requirements to obtain the loan. They can go on your credit score, for example, rather than requiring copies of all your tax returns, which would typically be required for an SBA loan. And then, like the PPP, there are no costs or fees to apply. You're not obligated to accept funds if you apply. Next slide, please. And then just real quickly, we already covered this, but the emergency advances, $10 billion additional dollars were appropriated for this part of the program. This is where you can get that up to $10,000 advance or grant that doesn't need to be repaid. There's some interaction if you attempt to use both an EIDL and a PPP loan. That's kind of beyond the scope of this presentation, but basically you don't want to use the loan proceeds for the same purposes. So you'd want to use that $10,000 for, and any other EIDL loan proceeds for things other than payroll costs and rent, utilities, and mortgage interest payments. So you'd want to keep those things separate. And then the EIDLs and the emergency advances are available through the end of the year, again, pending available appropriations. Next slide, please. All right, so that's the summary of the latest round of appropriations. There's not a lot there because they didn't change any of the program terms through the legislation itself. It's really just a couple of modest, the expansion I mentioned for agricultural enterprises and then the additional funding. So there's not a lot to report there. I think, the rubber will meet the road when the banks start processing and approving applications again. And, the SBA is going to, I think, need to provide them with some guidance on how to do that and kind of reopen the spigots, if you will. So there's probably more to come there. But from a legislative perspective, it's not terribly complicated. So I'm going to pivot now to, I was hoping that we would be able to talk about SBA loan, PPP loan forgiveness guidance, which we are expecting. We're told that the SBA is working on some more detailed guidance about some key questions around forgiveness topics. We've gotten a few FAQs related to this, but no detailed rules from the SBA around this. So what we do have, looking back to date, the SBA has issued an initial interim final rule about the PPP in general, an interim final rule about affiliation concepts, an interim final rule about eligibility criteria for self-employed individuals and certain loan pledge issues, borrower and lender application forms, various fact sheets, summary of affiliation rules, and then this frequently asked question document, which gets updated fairly regularly. It went about 6 days recently without being updated until yesterday, when there was a new FAQ added, and I would expect with additional funding being appropriated that probably some additional FAQs and guidance should be coming soon, I would hope. I'm going to drop a link into the chat section to the place where you can find all this guidance and FAQs. And then in addition to the kind of formal guidance, FAQs, rulemaking, there have been tweets and videos and interviews of congressional leadership or people who have participated in drafting the legislation, kind of stating what their intentions were, or publishing summaries. And some of those summaries have not been accurate and ended up conflicting with SBA guidance, or in some cases the commentary has been additive and seems to suggest there are additional requirements beyond what's actually stated in the legislation. The point of this slide is just, it's a very confusing landscape. In addition to the legislation, with all of this going on, a lot of times, I think, again, the SBA is proceeding in their best effort to roll out this program, but, unfortunately, sometimes when one question is answered in an FAQ, it raises two more, or it conflicts with something that a congressperson communicated, and it just creates confusion. So I'm going to try to focus on some of the FAQs and guidance that I think are clear and helpful, or most noteworthy. I'm not going to go through all 31 FAQs that have been put out so far, but I will focus on some of the ones that I think are most important for people to be aware of if you're getting back in line to apply, and in some cases if you've already received your loan proceeds. So let's keep going to the next slide. So the first FAQ that I want to touch on is question number 2, and this would be most relevant to a borrower that hasn't yet applied and trying to determine whether they're eligible or not. This FAQ came out, I want to say, several days after loan applications started being processed and accepted, and it basically said that you don't necessarily have to have 500 or fewer employees to be eligible for a loan. And part of that we knew already, because the legislation itself referenced higher employee thresholds for industries that, under the SBA's pre-existing rules, had higher employee thresholds under the SBA's size table. But this FAQ did clarify that a small business could also become eligible if they had a revenue-based size standard in that industry size table that the SBA just utilizes in other contexts. So that expanded the potential eligibility for the program to include certain businesses that might have more than 500 employees, but had a 3-year average revenues below certain thresholds based on that size table. And then another expansion, I think, in my mind, an expansion, but in the SBA's FAQ, maybe a clarification, was that any quote-unquote small business concern could be eligible if it met the SBA's alternative size standard test as of March 27th, 2020, which is the date that the legislation, the initial CARES Act legislation, was passed. And to qualify as a small business concern under this alternative size standard, a business at that date, March 27th, 2020, would need to have tangible net worth of no more than $15 million and average net income, after income taxes for the 2 full fiscal years preceding of not more than $5 million. So there's no employee-based test in that qualification test. It's really just about tangible net worth and average net income, which is pretty significant. And especially since the net worth test is limited to tangible net worth and excludes intangible assets and goodwill, for example, that opened up eligibility for a number of new potential borrowers that initially probably thought they were ineligible based on the actual legislation and some of the preliminary guidance from the SBA. So this is still good guidance if you're looking at eligibility. If you can meet those tests and qualify as a small business concern, then you can apply and make the certifications that are needed, notwithstanding that you have more than 500 employees. Next slide, please. FAQ number 7 from the SBA confirmed that this $100,000 per employee cap on annualized salary for purposes of calculating payroll costs only applied to cash compensation. The language in the statute itself referenced salary, so we kind of thought initially that this did not include employee benefits, and that's largely how this worked out. The SBA clarified that the $100,000 annualized cap on payroll costs did not apply to non-cash benefits, just cash compensation. So that was a helpful clarification. FAQ number 11, this is kind of a legalistic one, but it's an important one for anybody signing the loan application. It reminds borrowers and signatories of the application that they're representing to the bank and to the government that they are authorized to make the certifications that are in the application form. And for the business itself, the borrower, that may not be controversial. It may be clear that the person signing the form has that authority. The important thing to note beyond that is that they are certifying that they have the authority to make the representations that are required for each of the 20% or more owners of the borrower. And there are a few things in the application form that relate to people who own, or entities that own more than 20% of the borrower's equity. Things like not having been convicted of felonies recently, not being subject to bankruptcy proceedings and things like that, disclosing appropriate affiliations that exist. So if you're signing the form and you have 20% owners, you want to make sure you have the authority to do that and understand the required information from them to make sure that your certifications are correct. Next slide, please. The 14th FAQ basically addressed some confusion that came out pretty early with the way the legislation was written, combined with initial communications from the SBA about the measurement period for determining average monthly payroll costs, and then relatedly for how you calculate your number of employees for that 500 employee test or whatever other threshold might apply to your industry. And so the 14th FAQ clarified or provided flexibility to applicants to calculate their average monthly payroll costs as well as their number of employees based on either calendar year 2019, which is a deviation from what the legislation actually says, or the 12-month period prior to the loan application, which is what the legislation actually provides for. So basically it said you can use calendar year 2019 to determine your average monthly payroll costs, as well as your average number of employees to benchmark your eligibility, whereas the statute itself had only referenced the 12 months before the loan application. The next FAQ, number 15, confirmed that amounts paid to independent contractors or sole proprietors by a business should be excluded from the borrower's payroll costs unless the borrower itself is an independent contractor or sole proprietor. And the rationale is that those independent contractors or sole proprietors would potentially themselves be eligible for a loan under the PPP So it would not be appropriate to count them both in their own application as well as the application of another borrower. So their costs should not be included, even if they do not apply for a PPP in the end or aren't eligible for some reason. Next slide, please. FAQ number 16 was important. It directed borrowers to include the employee share, basically a gross pay concept, employee share of federal payroll taxes in calculating payroll costs, but to exclude the employer side share of federal payroll taxes. And this was confusing and a big open question to professional advisors, accountants, others, based on the original legislation, which frankly just wasn't drafted very well. So the SBA issued an FAQ to try to make sense of what the likely congressional intent was behind that, and this is where they landed. So you can use your PPP loan to pay, the employee's share of federal payroll taxes, but not to fund the employer side obligations with respect to the federal payroll taxes. And the same is true for calculating when you determine payroll costs for calculating your loan amount if you're still seeking a loan. FAQ number 20 confirmed that the 8-week forgiveness period would begin on the date that the lender made the first disbursement of the PPP loan. And then it further stated that the lender had to make that first disbursement within 10 calendar days after the date of the loan approval. There had been some earlier some summaries of the PPP that indicated that borrowers might be able to choose their 8-week period, but this FAQ made it clear that that wasn't really the case. Kind of going back to some of that confusion created by the various guidance and statements from people involved in writing the legislation. This stated really the only flexibility would be working with your bank to time that first loan disbursement to start the 8-week clock from ticking. And I think there was a question in advance of the webinar about whether anything in the latest legislation changed this, and the answer to that is no. There was, again, really nothing other than just the changes to the appropriations, so no changes in the 8-week period or when it begins were included in the legislation. Next slide, please. Okay, this is a really small font, but it's an important FAQ for certain potential borrowers, and this is the most recent FAQ that was issued just yesterday in the wake of some reporting about public companies or other large borrowers that were technically eligible for a variety of reasons to qualify as a small business concern. There was some reporting on this, particularly in the hospitality and restaurant industries where the SBA's affiliation rules were significantly relaxed. But because there was some consternation about whether borrowers in that situation should be able to take advantage of the PPP, the SBA came out with this guidance that was on its face directed at large companies with adequate sources of liquidity, specifically referencing public companies that had access to capital markets. But the FAQ reminded all borrowers to assess their economic need for a PPP loan under the existing standard established by the CARES Act and the PPP rules and regs. And basically it reminded people that before submitting an application, the borrower should review the required certification that current economic uncertainty makes the loan request necessary to support ongoing business operations of the applicant. and that borrowers should make that certification in good faith after taking into account their current business activity and ability to access other sources of liquidity to sufficiently support their ongoing operations in a manner that is not significantly detrimental to their business. I'm not sure this is very helpful for a lot of borrowers, other than in some of these clear-cut cases where large public companies that obviously had access to other sources of liquidity that would not negatively impact their long-term business. I'm not sure this is helpful for a lot of actual small business, what we might think of as quote unquote actual small businesses that maybe couldn't access other sources of financing. Doesn't say anything about whether you need, if you have an existing credit facility or potential sources of equity investment, whether you need to somehow memorialize that would have a detrimental impact on your business to make the certification. So this is another one of those instances where, to me, except in those clear-cut cases of borrowers that had capital already accessible but made that certification anyway, it's not clear that this is a very helpful FAQ because it doesn't really impose a new standard. It just says, hey, consider if you have other sources of liquidity that would, if used, not significantly detrimentally impact your business. And really, taking on additional debt is always going to, in some sense, be detrimental to your business, and it may be significantly detrimental, to a business if it pushes them closer to bankruptcy, for example, or makes the kind of carrying costs of their debt capital too much to sustain. So I think there's still a lot of room for good faith interpretation in this for virtually all borrowers to conclude that current economic uncertainty makes the loan request necessary. But the upshot of the FAQ is, to my mind, just make sure that you've gone through that analysis, and ideally, if you're a new borrower, set up a contemporaneous record of your thinking around why you need the loan and what you're going to use it for and why that is necessary. If you already made the certification previously, a couple things. One, the FAQs in a separate FAQ I didn't list here state that borrowers are allowed to rely on whatever guidance was available to them at the time that they initially submitted their application. So I don't think there will necessarily be a penalty to somebody who relied on the information that was originally available on this point, which was basically nothing. It was really just the requirement that you certify in good faith about current economic uncertainty making the loan necessary. However, if you're one of those companies where it's really clear cut that you had access to other capital, or you have since lined up other debt financing or capital equity investment or whatever to cover additional costs, and you're a borderline quote unquote small business, this FAQ did set up basically a mechanism where that type of borrower, or any borrower, if they're very concerned about this, could return their PPP loan in full by May 7th. If they were concerned that certification was not valid given this latest guidance, and the SBA would not consider the certification originally made to have been in bad faith. So there's some ability to return the funds if you're concerned that you'll be second guessed on this later. And I think, just again, based on the language in the FAQ, it looks like it's mostly focused on those larger kind of public company borrowers, but on its face, it does apply to all borrowers. Next slide, please. Okay, so those are the major FAQs that I wanted to touch on, and I'm sure there will be more in the future. One other thing that has come out in some of the guidance under the interim final rules that have been issued since we did a webinar on the second interim final rule related to affiliation issues, which you can access on our website if you're interested in that topic. But then a third interim final rule was issued, say about a week ago. And this was pretty specific to self-employment issues and loan pledge topics, but there was an important statement made in that context by the SBA related to partnerships and also to LLCs that are taxed as partnerships. And this was a little bit different than I think what people were expecting. This third final interim rule said that partners in a partnership may not submit a separate PPP loan application as a self-employed individual, which was where a lot of the professional advisor community believe the law directed partners in a partnership initially because they paid self-employment taxes, but they would, if they wanted to avail themselves of the PPP loan process, they would need to apply as a self-employed individual. And I think technically that's probably correct under the original legislation, but the SBA came out with guidance saying basically that would be overwhelming and too confusing because then you potentially have every partner in a partnership applying for a loan, and it would be unclear how you would allocate, responsibility for rent or mortgage interest payments or utilities to partners as opposed to the partnership itself. And so the guidance reads as basically, this would be too confusing to implement if we did it the way that it seems to be set up. And so instead of doing that, we're going to allow partnerships that apply to include self-employment income of general active partners, which is a new term that I wasn't familiar with, and I don't think has a really well-accepted legal definition. But anyway, it allows partnerships to include up to $100,000 for general active partners as payroll costs on a partnership PPP loan application. So the guidance basically says that a partnership should submit just one PPP application instead of having partners submit their own on a self-employed basis. And then for these quote unquote general active partners, you should include, it's not entirely clear, but presumably you can include up to $100,000 on an annualized basis of their Schedule K-1 earnings at the partnership level. The guidance didn't say anything about a partnership that may have already applied or an LLC tax as a partnership that already applied without doing that, because many advisors, I think, correctly interpreted the statute not to permit this initially, but then kind of pragmatism prevailed at the SBA in their third round of guidance and said, no, you can do this if you're a partnership and you shouldn't apply if you're a partner on a self-employed basis. So there was no kind of remedy set up for loan applicants for partnerships that were already approved to go back and then include partner compensation or distributions in their loan amount. But if your loan application is pending and you're a partnership, you do have the ability to pull that pending application back if it hasn't been approved yet. If you didn't include partner compensation originally, you could amend your application to potentially increase your loan size based on this guidance. The one concern I guess I would have about doing that in the current environment is, given the limited amount of the funds, whether that would complicate getting your loan approved before the additional $310 billion in appropriations is exhausted. but something you may want to discuss with your bank if it's easy to amend the payroll cost calculation without jeopardizing your loan application status. It may be something you decide you want to do if it meaningfully changes the loan amount. Next slide, please. Okay, so then I was looking back. Looking ahead, we're still waiting on, as I mentioned, the SBA final interim rule and guidance on some of these key forgiveness issues and questions. Some of the open questions that we're getting most often are, and which are in my mind pretty fundamental to the whole process, are how exactly do we calculate full-time equivalent employees? There's no helpful definition in the legislation or any of the guidance on that topic. So, a number of professional advisors have looked at other federal legislation like the Affordable Care Act to kind of figure out what that might mean, but there's nothing put out there by the SBA that is helpful in affirming that that's okay, or how one should go about doing this. But I think the most we can say right now is just that you should be consistent in how you calculate your FTE employees, since that metric is used in a variety of contexts under the law and the forgiveness criteria. Hopefully we'll know more soon on that. And then also in a similar vein, how exactly do we calculate decrease in loan forgiveness percentage based on reductions in salaries and wages? That seems to be, the act itself suggests that it might be on an employee by employee basis, as opposed to like an aggregate payroll concept. I think it probably will be on an employee by employee basis, but that may be a difficult thing to administer. And so similar to the partnership issue we just talked about, it'll be interesting to see if some level of administrative pragmatism kind of overrides the statutory language there in terms of how that forgiveness percentage is determined. Another very important question that we get posed to us frequently in one form or another is basically whether the forgivable costs are determined on a accrual basis or a cash basis or some combination. The language in the statute is not crystal clear on this. It references, I think the verbiage is amounts, costs incurred or amounts paid, or costs incurred and amounts paid, which, I think you could use to support an argument for either accrual or cash basis determinations of forgiveness. I think, again, just based on pragmatism of how this will ultimately work, I suspect because its forgiveness will need to be established with the banks, it's going to be a lot easier to do that by just showing a cash trail of payments basically during that 8-week forgiveness period, as opposed to, somehow establishing what amount was properly accrued during the 8-week period. So we don't have firm guidance on this yet, but I would think that cash basis is the more likely result here, but we just don't know for sure. And then there's a concept about hiring back previously laid off employees by June 30th in order to mitigate an otherwise negative impact on your forgiveness percentage. And it's unclear, to my mind anyway, whether you need to hire all the way back to your original levels by June 30th in order to mitigate that impact on your forgiveness percentage, or if there's some kind of proration concept that will apply. One would hope it would be the latter, which would incentivize some level of rehiring, even if you can't get back all the way to your pre-COVID levels. But that's still an open question. And there are many, many others I'm sure that folks have that we're still waiting guidance on. And in the meantime, I think the important thing is to bear in mind the policy objective overarching all of this, which is to use the majority of the funds, at least 75%, to keep employees paid during that 8-week period. And so until we get more definitive guidance, I think things you do consistent with that approach and your prior practice are kind of the the safest bet for moving forward. One note here before moving on to the next slide. The second to last bullet point here about hiring back previously laid off employees by June 30th. Just a reminder that that concept only applies to reductions or layoffs that occurred between February 15th and April 26th. So today's April 24th. So after Sunday, this cure concept will no longer apply to reductions in FTEs or reductions in wages that occur starting on Monday, which will be the 27th. So that's just an important timing consideration for people to be aware of. Okay, let's go on to the next slide, please. All right, and then before turning to some of the Q&A that have lined up, just some reminders about enforcement and Freedom of Information Act issues. It's clear that on the application form that if funds are procured impermissibly or fraudulently, then the government is retaining its ability to pursue fines or civil or criminal charges. There's also False Claims Act incentives for kind of independent enforcement of this, the proper use of this program. And then related to that, there's an ability for the public to obtain information about participants in the program through Freedom of Information Act requests, including the names of borrowers and loan terms. So just something to always keep in mind as you're going through this process and applying or otherwise submitting information to banks and the SBA. Okay, I'm going to spend some time now looking at the Q&A that have lined up, and I'll do my best to answer some of these. If I don't get to your questions, my contact information is up there, and you should certainly feel free to reach out to us. We have other people in the firm who are up to date on PPP issues as well, so we'll connect you with the right person if you'd like to speak with one of the Miller Johnson attorneys, or if you have kind of related questions in the employment area. We have kind of a cross-functional group who are working on these types of issues. Okay. So there was a question about it says the new provision states some level of credit elsewhere testing. Will you address this for private companies without access to capital markets? Yeah, so there's not a new, it's really just that one FAQ, number 31, that was put out yesterday. And it doesn't change the fact that there is still no credit elsewhere testing. It merely, for both public and private companies, encourages them or directs them to consider whether they do have access to other capital that, if used or tapped, would not have a significantly detrimental impact on their business. So again, I would just recommend kind of going through that analysis, particularly if you're a new borrower, and documenting your conclusion on that front, understanding that certification is, a certification to the bank and the federal government that the loan is necessary given economic uncertainty to support ongoing operations. There's really not any more definitive guidance beyond that, other than the wording of the FAQ seemed to be more directed at public companies and very large companies that were technically eligible, but which had access to other capital. So if you're a smaller company and you don't have access to other capital, just note that in your record and as well as your need for the loan to support payroll, and then of course use the loan appropriately to fund at least 75% payroll costs. Okay. There's a question about the forgiveness of utilities is vague. Is there a specific list of what utilities includes? Telephone, cell, garbage, etc. There is a list in the statute itself, which you can find. It does not include garbage on the list, but it does include, I'm going by memory here because I don't have the legislation right in front of me, but it's gas, electricity, water, telephone, internet, transportation, I think are the items on the list. But I know garbage is not included as a utility on the list, but the Act itself does include a definition of utilities. There was a question about how does an independent contractor satisfy the forgiveness criteria, pay yourself, pay your health insurance premiums. The short answer to that is yes. There's guidance, the third interim rule, if you click through to that link that I posted about the guidance and the FAQs. If you look at the third interim rule for self-employed individuals, it goes through in significant detail sort of what the permitted uses and forgiveness concepts are for independent contractors and self-employed individuals. But yes, basically, you're going to pay yourself kind of consistent with the way you may have done it in calendar year 2019 to fund up to 8 months of your kind of take-home pay. But not 8 months, 8 weeks of your take-home pay. Okay, another question. In regard to the health expenses employers can claim under PPP, is this strictly health medical costs only, or does it include other employer-paid benefits as well, life, long-term disability, dental? So there's no clear guidance on this question other than it's clear that the health care expenses are included. Our view has been that dental should be included as a health-related benefit, but we have not considered life insurance or long-term or short-term disability, those types of insurance to be health benefits that are forgivable. We'll see if the forgiveness guidance changes any of that, but that's where we have come down on just a reading of the statute itself in the absence of any guidance. Question, is there any substance to a rumor that has been circulating that the 8-week period may be expanded to 10 weeks? There's no substance in the legislation, and so it would take either an act of Congress or I guess a very an act of the SBA administrator that conflicts with the existing statutory language to change that to a 10-week period. So I'm not aware of anything that would actually achieve that, but I suppose anything is possible given the way that the program has been rolled out so far. Question, can you give someone a pay raise during the PPP 8-week period, and if so, will it be included in forgiveness calculation? We've gotten that question in different forms from people. There's nothing in the Act that restricts providing pay raises other than the cash compensation cap of $100,000 per employee, which works out to $15,384 over the 8-week period. So if you pay someone in excess of that, it will not be forgivable to the extent beyond that amount. But I know many employers are, for example, planning to pay some kind of hazard pay to employees who are on the job during that 8-week period. And while there is nothing restricting that under the Act, there's also nothing in the guidance that says, yes, affirmatively, you can do that. So in my mind, this goes back to the purpose of the legislation, which is to keep employees on payroll and paid during this 8-week period. And if part of that involves giving them a hazard pay type situation to induce them to continue working and keep them paid, that would seem consistent with the overall purpose of the Act, the PPP scheme. So we don't presently see any issue with that, and I don't know. We'll see if the SBA somehow says in guidance that that would, for some reason, be unacceptable. I think as long as it's for your your employees who are coming in on the job, in particular, and it's styled as hazard pay and not as some kind of advance on a bonus that's payable in the future, that is probably going to be okay. But we don't have guidance that specifically affirms that that is the case. Okay, there's a question about how long do you have to use the money? Is it only until June 30th? So you have 8 weeks after you get your loan funded to use the loan proceeds for forgiveness on a forgivable basis within the categories of payroll costs, rent, utilities, and mortgage interest payments. But you could leave the loan out for up to 2 years. That's the maturity of the loan, and use the loan for the permitted purposes beyond that 8-week period if you wanted to. But your forgiveness amount would be limited to just funds spent during that 8-week period. So if you use it beyond that time frame, it would be okay as long as it's a permitted use and you go back and repay it with a 1% interest beyond that 8-week period. There's a question, are new hires not employed prior to COVID-19 that are hired during PPP 8-week period included in the forgiveness amount? Yes is the answer. There's no concept in the law or in any of the guidance that limits the forgivable payments to only those same employees who were working before the onset of COVID-19 or during, who were included in your base period calculation. So they don't have to be the same people. If you rehire your employees in late June, will that eliminate both the FTE headcount decrease and the wage decrease reduction to forgiveness? If you rehire employees, the way the statute is written is that for employee reductions between February 15th and April 26th, you have until June 30th to get back up to your prior FTE, or if you've reduced wages by more than 25% to reinstitute prior wage levels and not otherwise be penalized on your forgiveness percentage. So the answer is yes. In general, if the reductions occurred before April 26th, but I think there will probably be some more guidance on this question because we've gotten a lot of inquiries about, well, how long do you need to continue to employ people beyond June 30th or keep those wages in effect? And there's really no guidance on that at all. So I would expect that there will probably be some guidance about committing to keep those same FTE levels or trying to keep those same FTE levels or wage levels beyond June 30th. But we have to wait and see what the SBA ultimately says about that. I can't imagine they're going to leave it the way it is right now, which technically would just merely require you to hire people back on June 30th and then kind of do what you will after that date, which wouldn't seem like the most sensible outcome. And I'm just going to, I know we're well past time here. I'm going to keep answering some of these questions because I have time at the moment, another 5 or 10 minutes at least. So I'll try to choose ones that I think are kind of more broadly applicable. For the EIDL loans, if we have applied for the advanced grant funds portion of that loan, should we reapply for those funds? If you applied for an EIDL loan, including the advance, and you were approved but not yet funded, I don't think you need to reapply, but because I know there were some delays in getting those grants funded initially, so it may be that if you've already got that approval, you want to follow up just to make sure it's being funded, but I wouldn't necessarily reapply unless the SBA tells you to do that, because having multiple applications in could be or would be a violation of the program rules. So I guess it just depends on whether you were denied originally. If you were originally denied because the program appropriations were maxed out, then it's probably right to reapply. But if you're just waiting on funding because you were approved, then I think you want to touch base with the email the SBA or call the local office just to make sure that now that there's additional funds, that there's nothing further you need to do. The business receives a $10,000 EIDL grant. Can the same business receive PPP loan and still be eligible for total loan forgiveness if the PPP funds are used for payroll costs? There's some ambiguities still about how these two programs can be used side by side, but if you receive an EIDL loan and you do not use it for payroll costs or for any of the other eligible expenses under the PPP. So if you use the EIDL for vendor payments, for example, and you use the PPP loan funds for the payroll costs, rent, utilities, mortgage interest payments, you should still be eligible for total loan forgiveness. If you got your EIDL funds before April 3rd and you did use them for payroll, you'll be required to refinance that into your PPP loan, and it'll just increase the amount of your PPP loan, but your forgiveness amount will be reduced by the $10,000 grant because that does not need to be repaid. There's a question about speaking more specifically about self-employed portion of PPP, because self-employed people couldn't start applying, and this is correct, for over a week, after other companies were eligible. So the application process opened for most on April 3rd, or for businesses on April 3rd, didn't open up to self-employed individuals until April 10th, and that was, well into the funds being utilized based on loans that were already in the pipeline, so to speak. And so this person is commenting that, funds have been difficult for bankers and the bankers seem to be fuzzy on what self-employed individuals need to provide. I'm not going to go into all the details, but I agree that in general, with the frustration that a lot of the funds were already used before the self-employed individuals could even begin applying on April 10th. And then the SBA's third interim rule, which is available at the link that's in the comments section on the Treasury website and the SBA's PPP website, wasn't released until after April 10th. And so banks, even though they could accept those applications on April 10th, probably didn't know what they needed to substantiate payroll costs. But that third interim rule does provide a lot of guidance on what specifically needs to be given to the bank. And one issue there, I won't touch on all the issues, but for self-employed individuals who haven't filed their 2019 tax returns yet, the rule does incentivize getting those tax returns filed sooner than later, because banks may need to have those tax documents in order to validate the appropriate amount of the loan on the front end. So just something to look at in that third interim rule on eligibility, which includes a lot of discussion for self-employed individuals. There was a question about speaking to the retirement plan benefits that are included in the PPP, just employee match or all retirement plan contributions, and then there's a list of other potential. Basically, the act itself just references retirement. I benefits, and there's really no guidance provided about any of this detail. So the language in the Act itself is pretty broad about what potentially could be included in forgivable retirement benefit related payroll costs, but unfortunately there's no guidance on any of like these specific questions about profit sharing plans, cash balance plans. So unfortunately I can't speak more specifically about those, other than I think the language in the statute is pretty broad about what types of retirement amounts can be included in payroll costs. There's a question about, I did not apply for a small business loan yet, and I do not have a way to, there's somebody who can help them right now. If you're in that situation where you don't have an existing banking relationship and you want to apply for a PPP loan, my sense is the best bet for a person in that situation is to go to one of these smaller credit unions or financial institutions that have had this $60 billion earmarked for their origination. But be prepared that it's going to be a little bit more cumbersome to go through that process with a new, if you don't have a pre-existing relationship with them, because you would need to provide your customer information and find the right right contact at the bank to help get you through. The SBA and Treasury websites both do have links to lender matching services or portions of their websites, so you can go onto that website through the Treasury Department's CARES Act webpage or through the SBA's webpage to find the kind of lender borrower matchmaking tool. Yeah, I do a couple more questions. I don't think I'll be able to get to all these, unfortunately. Question here, can you apply for the PPP through multiple banks? No, you can only have one. Well, any given borrower can only apply once and only at one time. So you can only have one application pending for any eligible borrower at one time. So you can only, therefore, have it through a single bank. If you had multiple borrowers that were eligible after applying all the affiliation rules and everything like that, they could separately apply through different banks. So each borrower may only have one application pending at any given time. There's a question here about the PPP is first come, first serve. This person submitted the loan application on the first day, and we're told the bank approved the loan, but that the SBA was the holdup. Is there any idea how banks and the SBA are lining up loans for approval? What recourse would be available for loans submitted timely and appropriately but not funded? Really, unfortunately, I think it's going to, we'll know more in the coming days after the SBA kind of gears back up to start processing loan approvals again. Some of this may be on a bank-by-bank basis, how they kind of restart the process of getting loans approved and funded. But I agree with that frustration that we know of many borrowers who submitted applications seemingly with all the required information and didn't get the loan approved even though they were on the early side. So, I would just suggest being proactive with your bank until we know more about whether the SBA imposes any formality around the process for an orderly approval of the pending loan applications. Will employees drawing unemployment or using extended paid sick or EFMLA affect the loan forgiveness? Potentially. If you're using certain tax credits to fund leave, that will not be allowed as both getting a tax credit and a payroll cost, so that could impact your loan forgiveness directly and indirectly, since it would reduce the amount of your quote-unquote payroll costs that count toward the 75%. That indirectly reduces the amount that is eligible for that 25% in utilities, rent, and mortgage interest payments. And then employees who are drawing unemployment, to the extent that they're drawing unemployment, presumably they're doing that because their pay has decreased, which would reduce, so again, that would reduce your payroll costs. So both of these things, either directly or indirectly, would at a minimum affect your payroll cost level. That would be forgivable, and they could impact your full-time equivalent employee levels as well, especially for people who are on unemployment. There was another question here about the 8-week period and whether there is any indication that that might change to something more reasonable after the state stay-at-home and essential business orders have lifted, and the answer is no. There's nothing out there right now that would suggest that there's going to be more flexibility around that. There's a question about whether there's any update on Main Street lending program, which is that's more for mid-sized borrowers and not a forgivable loan. I checked late last night and there was no update from the Federal Reserve on that. I haven't checked again this morning to see if there were any new releases. The Fed had been soliciting public comment on their initial proposed loan terms for the Main Street lending program. It looks like there was a new press release late last night or late in the day yesterday, which I just candidly haven't had a chance to go through yet. So there may be some more information out there now on the Main Street lending program, but we'll follow up separately. I know Johnson with probably another webinar or client alert about that when there's more detailed information. But yeah, that's a separate program that's not forgivable, and it could be used side by side with a PPP loan. So if you're a PPP loan recipient, don't necessarily rule out the idea of a Main Street lending program loan. Okay, there's a question. If we pay semi-monthly, when would the 8-week period start, and would we need to base it on hours worked during that period or pay dates during that period? That goes back to this question about cash versus accrual accounting. Clearly, the 8-week period will start once your loan is funded. I think clearly pay dates that fall within that 8-week period are going to be eligible for forgiveness. Whether there's some ability to accrue additional amounts for pay periods that are after that that relate to work rendered during the 8 weeks, but it gets paid later. I'm skeptical about that, but we'll see if the SBA provides any helpful guidance on that whole question. There's only 4 questions left, so I think I have time before 9:30 to just get through all these. Would marketing expenses be included as part of forgiveness? No, they would not. Can you include your HELOC payments in the calculations? I don't know about that. Definitely marketing expenses would be out. Home equity loan, line of credit. I I don't know if that would be considered a mortgage interest payment or not. If it's not used in your business, I don't think it would be eligible, but if you're a self-employed individual, I think the answer to that, based on my recollection of the third interim rule, would really relate to whether you included that as a deductible expense on your prior tax return, on your 2019 tax return. But you either want to consult with your advisor on that one, or yourself, kind of read through that third interim final rule. How do you know if you are approved for an EIDL loan? I haven't applied for one, so I can't say I'm familiar with the process, but I presume that you get an email affirming that you've been approved, or some kind of subsequent communication from the SBA about approval. You apply for EIDL loans directly through the SBA website, so I think it would come from them. You wouldn't be looking for anything from a bank, for example. Question, do you have any insight if our 8 weeks runs out by the first week of June? Is that the time frame for FTEs are measured? Yes, it is. You're going to measure your FTEs for purposes of loan forgiveness relative to that 8 week period. And then and loan forgiveness measured, or is forgiveness not determined until June 30th and takes into account FTEs after the 8 week run for PPP spending purposes. So in the first instance, you're going to look at your full-time equivalent employee average during that 8 week period based on average amounts for each payroll. The amount you're going to average the number of FTEs per payroll period during that 8 weeks. For people that were laid off before April 26th, you can rehire them or somebody else, doesn't have to be the same people, before or by June 30th. And if you get back up to where you were before, then you won't be kind of penalized on your forgiveness for that initial reduction, even if it was reduced during the 8 week period. But you're going to have lower payroll costs during that 8 week period if you have more people on layoff or furloughed. So it will reduce your loan forgiveness amount either way, whether directly because you don't have people working during that 8 week forgiveness period, or because your FTE employee level is lower during the 8 week period compared to your base period. But you can at least mitigate the impact of that lower level if you rehire by the end of June. Would workers' comp insurance payments be considered part of payroll costs? To the extent that the workers' comp insurance payments are levied through a state or local tax on employee compensation, the answer is yes, because payroll costs clearly include state and local taxes imposed on employee compensation. But if it's something outside of that, I would say the answer is probably no. And then the last question here, can new employee benefit plans be funded via loans such as HSA funding of $1,000 per employee allowed if you meet the rest of the rules for HSA, or to increase 401k matching funds? I think the answer is yes, or that there's no restriction on having payroll costs that are new categories of payroll costs for you, as long as they're otherwise eligible payroll costs under the definition. There would be limits on, for example, new rental payments or utility payments that you took out after February 15th, or mortgage interest payments that are new after February 15th, but there's no similar limitation on employee benefits that are created after February 15th. So there's nothing in the law that would restrict this as long as it's an otherwise forgivable payroll cost. And then there was one more question put in about tuition reimbursement programs, and if that would factor into the PPP loan, would that be eligible for forgiveness expense? I think the answer there is no. I don't think that's the type of employee benefit that is generally going to qualify for forgiveness. It's not a health or retirement plan, so I think it's going to be hard to establish forgiveness for that one unless it's being funded somehow, directly by the employee and only by the employee, but like the employer portion of any matching for a tuition program is probably not gonna count. Okay, so it's 9:30. I have to leave for another call, but I'm glad we were able to go through a lot of questions. Just remind people, if you have detailed questions like this, consult the SBA guidance, consult your professional advisors, lawyers, accountants, banks, and try to stay current because this is a very fluid and complex program. So if you have questions, you can come to us, and we'll do our best to help work through everything. If you've gotten your loan approved and funded already, we're going to be on the lookout for the additional forgiveness guidance, and I'm sure we'll be doing another webinar to walk through either things that are confirmed in that guidance or any new concepts that may come out and change the landscape again. So with that, I appreciate your time. Thank you as always for engaging with us. It's a nice way to stay in touch with people in these unusual times, and I hope you have a great day. And I think today is Friday, so if it is, have a good weekend as well, and I'm sure get a chance to connect with folks again sometime soon. Thank you.